So hello everyone, I'm Mark Swann from Holborn Assets. I'd like to say good morning, good afternoon or good evening to you, subject to wherever you are logging onto this webinar. Initially, let me thank you for your time and your attendance. This webinar is proposing that now is the time to enter the UK property investment market, and we're going to explain why. So I'm going to hand over to the experts, that's Johnny and Andy from SevenCapital, and also to Hiten from Visionary Finance, who's going to discuss the lending facilities that are available. Now, as the webinar is going on, you may well think of questions, and we'd invite you to use the Q&A facility at the bottom of your screen. Please type away with your questions, and at the end we will have a Q&A session where we'll all do our best to answer your questions here and now. Okay, just lastly, want to remind everyone that this is being recorded, just to let you know that. And without further ado, I'd like to pass over to Johnny. Over to you, Johnny.
Thanks a lot, Mark. Appreciate the introduction. Hi, everyone. Good afternoon, or whatever time of day it is where you are. My name's Johnny Conran, and I am the head of the Middle East and North Africa for SevenCapital. And as Mark said, I'm going to give a bit of an overview about SevenCapital and who we are as a group and what the group entails for those of you that don't know who we are. So if I could go to the next slide, please. So I think to start with, one thing to mention is that SevenCapital are the developer. 90% of the time when you deal with property acquisitions or buying a property, or in fact dealing with anybody in the property world, you usually deal with agents, whereas the rarity here is that SevenCapital are actually the developer. So not only are we the developer, but if you look on your screens and see Holborn construction, we actually not only buy the land ourselves, but we also build everything ourselves as well. So this is very rare within our industry, and it's a commitment we made about 10 years ago because we wanted to keep the quality of what we build to a certain standard. We've built a brand, and we built the best brand within our sector, and that's what we wanted to keep consistent, and the best way to do that was by building everything ourselves through our own construction company. So as I say, that's very rare within our industry, but it gives us a sort of a niche that perhaps others in the industry don't have. Looking through your screen, you'll see we own a media company, 7 homes, 7 events, 7 retail and 7 industrial are different areas within real estate. So the industrial side are the warehouses that you'll see on the side of the motorway, perhaps that Amazon own and keep all of their stock inside. Holborn and SevenCapital build those as well. So our real estate portfolio spans through commercial, retail, as well as obviously the residential, which we're talking about today. If you look further down on your list, many of you might recognize the Park Regis logo. So there's a couple of those in Dubai, they're in Bali, in Singapore, Australia, the UK, of course, and SevenCapital owns those hotels. So there's about 40 of them worldwide. That is the only part of the business that is international. Everything else that we build is UK based, all the residential properties, etc. But the Park Regis obviously are in various different countries. And then on the left, you'll see Synergy Bank. Now, Synergy Bank was our most recent acquisition. That was previously the Bank of Cyprus. SevenCapital bought the Bank of Cyprus about 2 years ago with a loan book value of about £1.5 billion. And that now sits at about 2.5 billion. So obviously big growth over that 2-year period. And what it means, more importantly, is that the SevenCapital group is valued at just over £6 billion. Now, this is something that I think is really important to reiterate nowadays more than ever, because if you read any real estate report from JLL or Savills or any of the PLCs, they'll all tell you the same thing, that right now, if you're looking to invest into real estate, you want to make sure that you're investing with a company that has a proven track record and cash reserves behind it, because inevitably, amidst the situation we find ourselves in, the smaller developers are going to be taking financial haircuts, which equates to a sort of detrimental product, or if worst case scenario, no product at all. So all of the advice is the same from the latest reports, which is why companies such as SevenCapital, your Galliards, your Berkeley Homes, the big developers are the ones that you want to be looking to invest with. So we move to the next slide, please. So focusing just on the residential side of things, we've built just over 6,500 residential units, 7.8 million square feet of property, and a portfolio of £2.1 billion. There's 130 of us working directly for SevenCapital, dotted around the world, which I'll come on to. But again, this just reiterates the fact that we're a proven developer, and over 10 years, we've built and completed a substantial amount of properties around the UK. Next slide. So these are some of our completed developments, and the names won't mean a lot to you, but I think it's important to point out that SevenCapital buy sites in key locations, strategic locations that tend to be regeneration areas. As a developer that builds investment property, we have a responsibility to buy in areas where our clients are going to receive obviously a decent yield, but perhaps more importantly, substantial growth over the coming years. And that's where our success has really been from, as I mentioned, from our acquisition team buying and choosing these specific locations. So these properties you'll see on your screen are dotted around the UK. Andy, our CEO, is going to talk to you next about some of the sites and areas that we've chosen to build on more recently and the reasons why. So if we go to the next slide. And again, you'll see here that we've got another £727 million worth of property that's currently under construction. So these properties are either completing this year or within the next 18 months. So there's a lot in the pipeline, and what that equates to is obviously more opportunities and more options for our investors, both new investors as well as repeat buyers from our 10-year history. I think, again, it's important to mention that although we've been through these months of uncertainty, and again, Andy will talk to you about where we are in the market now, we've actually seen this as quite a big opportunity at SevenCapital to buy land and buy sites. These developers I mentioned earlier, perhaps the smaller developers that aren't going to be able to complete and want to sell their land and sell their sites, we've managed to benefit from that, which obviously means that in the coming months and years, we're going to have plenty of different sites and plenty more stock to offer our clients. Next slide, please. Right, so turnkey developer. Now, this is a really important slide. It basically summarizes our commitment to customer service as a business. And again, talking about rarities within our industry, SevenCapital commit a huge amount of resource and time into the customer service element of your purchase. Those of you on here that have bought properties before know that it can be quite a laborious process, particularly if you're 3,000 miles away from the property itself, or however far you may be. So what we've created as a business is a structure whereby we help from every step of the way, from the legal side, from the tax, from the mortgages, which obviously Hiten is going to talk to us about, from lettings and post-completion as well. So this is very rare. You'll see below that it's resulted in us winning awards consistently every year, because it's a big commitment, as I say. Normally when you're investing into property with a company and they say they have customer service, it entails a couple of people in their office. SevenCapital have an office in the UK with 50 staff, all of them within a specific department, whether it's tax, whether it's mortgages, so that you have your hand held directly with the people that are actually building the property. And it's important to mention that rather than using that as a revenue stream ourselves, we actually do the opposite. We leverage economies of scale, the fact that we're a big developer and give a lot of business to these partners. They in turn give you, the client, or the investor, a better rate. So it works really well, and it's resulted in us obviously having repeat buyers over the 10-year period, because it's not just about the quality of the product, it's about the experience. For those of you that are based in Dubai or in the Middle East, our solicitors and a lot of our partners are based on the ground there, which again, obviously makes the process a lot more straightforward. Next slide, please. Okay, again, just reiterating what I've just said, our headquarters are in the UK, in London, and we have 2 offices in Birmingham. We've got physical offices in Dubai, Hong Kong, Singapore, South Africa, but those offices facilitate investment from overseas buyers into the UK. To put it into scale, 50% of our business comes from the UK operation, and 50% comes from all of those overseas offices combined. So the point to make is that dealing with investors overseas every day means that we know how the process works, and we can deal with each relative case through experience and something that we do every day. So it's not something that's going to be new to us, and therefore won't be as laborious a process for you. And I think that might be the end of my slides. So without further ado, if we can move to the next slide, I'll hand you over to Andy Foote, who is SevenCapital's CEO.
Thanks very much, Johnny. A great presentation as usual. I hope you found that informative. First of all, thanks very much to you, Mark, from Holborn, for inviting us to come and talk today. I'm going to be as quick as I can because I'm conscious of your time. But we've enjoyed a strong four-year relationship with Holborn to date, helping their clients, some of their clients, with their pension planning via property. And so, yeah, thank you, Mark. Also, the idea of today is that you find this informative and you hopefully get some little nuggets of information to help guide you, if you like, if you're thinking about investing in property. So I do hope you're going to get those. And then the last thing is a reminder about the questions. If you've got any questions, please type them in, because we'll do a Q&A at the end, and often that's the most helpful part of the presentation. So I'm going to cover two things. One about the current market, because obviously we're in unusual times, and it's interesting to find out how the market's reacted to the pandemic. And another thing, and the second thing I'll move on to is about some of our developments, opportunities, if you are interested, that you might want to consider. So let's move on. First slide. So yeah, I think there are 5 parts to this, the current market and why now. And the first one, most of you will know about the stamp duty reductions. The UK government have brought this in to help boost the market in these troubling times. And I have to say, it's worked very well indeed. The actual homeowner market, which is not our market, is booming, and Rightmove are, in July, they quoted Rightmove are the local estate online estate agent in the UK. They quoted their busiest ever month since they started, which was 20 odd years ago, in July, because of this stamp duty saving. So what does it mean to us? Let's have a look on the next page. Yeah, it's given us a few illustrations here. It's not massive, because as you know, the government put the 3% levy on a few years back for all investors in buy-to-let property, but people were making so much money from if you're looking at a long-term view, you know your property is probably going to double in value over 15 odd years. And if the rent helps to pay the mortgage, people are doing very well with their pensions long-term in property. And so they knew that they could put the stamp duty on, but now they've taken it off for a period of time. So these savings, if you look at them there, I can't see them all, but there's £1,500, something like that, on a £200,000 property. Second property, 275,000. There's 3,750, and then I can't see the last one because there's things on my screen, but you can see that there. The important thing to notice with the stamp duty savings are that they finish in March. We're not sure if the government are going to extend it. I think they'd like to, because it's been very popular, but I think it'll be too costly for them, and at that point they'll start thinking about recovering some of the debt. So we've got this window of opportunity, which would make you, if you were interested in this, it would make you look more at the physical properties, the properties that are actually ready now or completing in the next 6 months. The other thing to mention is, before COVID, the British government talked about adding another 2% stamp duty, levying this for investors, offshore investors and UK investors. Again, trying to win funds for the British economy through easy wins, basically. And so they know that because, as I say, over a period of time, people are making significant amounts of money through property, that it'll stand up. We don't know that that's coming in. It's just been muted. So it would just lend reason to why it would be a good idea to do it now if you've got the cash and you're thinking about it. So what's the next slide? This is an interesting one. The actual buy-to-let mortgage market has been contracting for the last couple of years as the global economy has been aging, as the economists call it. The underwriters have been contracting their appetite. So we've seen it shrink. SevenCapital have delivered 2,000 apartments in the last 18 months. And out of those, something like 1,500 wanted mortgages, and we've got them all through. So we're a bona fide company, and the lenders will work with us, as Johnny mentioned earlier. But your options are less. However, since the bank base rate has been reduced to 0.1% in the UK, this is a time for lenders to profit, because they won't reduce their 3% or 4% or whatever they're charging for a buy-to-let mortgage. And so the fact that it's come down from 0.5 to 0.1 or 1% to 0.1, it's all profit for them. So they were chomping at the bit in May and June to get back into the market, and Hiten will talk to you about that shortly. So it's a good time, I think, right now. We're not getting savings, they haven't been passed on, but there's an appetite now for lenders to lend again. Okay, next slide. So the third point, we've talked about stamp duty savings, we talk about access to mortgages, and the third point is the currency exchange. This slide gives you a simple show of what's happened in the last less than a year really, where the exchange rate has changed again. And so if you're investing with dirhams, if your money's in dirhams, you can see the difference for every 20,000, the saving there is 4,000 on 250,000 pounds. So you'll have all been aware of the currency fluctuations over the last 5 years. Ever since it was in 2016, Brexit was announced. There's been advantages in the Middle East to invest in the UK, not just the Middle East, all around the world. They won't last forever. We know that the pound will recover to its normal positions, and these savings will go. Okay, next one, please. This is one of my favourite ones. The proof's in the pudding. This is, what's it go back to? 1977, and each vertical dotted line tells you when property prices have doubled. So look at those early days. You can see the baby boomers made all the money. This was my time. All the money, look, doubling in 5 years, doubling in 6 years. Then it went to 13 years, and now it's the last one was 14 years. So I'm predicting that in the next 15 years, whatever we buy today will double in value. Who can tell? 10, 15 years, anything can happen. Pandemic, financial crash, Brexit, etc. But we've had all of those things in this historic period, and yet property continues to double over a period of time. And the simple reason is it's supply and demand. There's a huge undersupply of property in the UK, and there has been for 30 years. We can't build them quick enough to satisfy the demand. And of course, this causes property prices to increase. If you wanted to call the market, so for example, the stock market, people go around the twist trying to buy at the right time and sell at the right time. It's almost impossible. You're better to go for a long-term, safe strategy where you know that over that period of time, it doesn't matter if you buy at the top or buy at the bottom, you're going to be in the pound seats because it's going to double in value. We'd all love to maximise it, but it's near on impossible. My saying has always been, it's not timing the market, it's time in the market. We would all love to look back and think, oh, we bought that for 200,000 instead of 225,000. But if it's going to 400,000, it doesn't really matter in the big scheme of things, as long as the most important thing isn't what you bought it for and what you sold it for over a period of time. It's avoiding voids. These are our shark-infested waters. This is what can go wrong with property. If you invest in a property and it's empty and we can't rent it, it becomes a bad investment. It's like stocks that don't provide dividends. You've suddenly gone from income to expenditure to cost, because you've got the cost of ownership with the service charge, the ground rent, and possibly the mortgage. And so if you haven't got income, it becomes a noose around your neck, a millstone around your neck. And I've been there myself in the past. So the most important two things for you to consider, to take away from this presentation, are make sure you choose the right partner. 95% of people out there selling property in the UK are agents. They're not developers. They have no control over the finished product, when it's going to come, if it's going to come, and what the quality is. So go with a proven developer with a proven track record. That's the first thing. But first, do no harm. The second thing is the cornerstone of any property investment, whether it's residential, commercial, industrial, whatever, retail, is the tenant. The cornerstone is the tenant. Without a tenant, it doesn't work. Without a tenant, it goes down in value and you get no income. With a tenant, it continues like this graph up in value, and the tenant income pays for everything and gives you a profit. So you're looking for sustainable tenant demand. You're looking for, what does that mean? That means regeneration programs in towns and cities, creating jobs, universities, students, etc., etc. This is where, Johnny mentioned this earlier, we only buy in these places where we can see the tenant demand for the next 25 years, because that's what you need. Okay, I went on a bit there, sorry, next slide. Interesting one. So third parties, we know all of these, of course. These are the PLCs, Knight Frank, Savills, etc. Independently, we went to the market in June and July and August and said, tell us what you think over the next, between now and Christmas, and also over the next 5 years. And they're all predicting between 5 and 12% increase there. I think we're at a kind of slow point in the market now. I don't see a huge correction coming, because it's to do with supply and demand. But I think we're in a slow point now, and then I see the whole thing taking off again at the end of 21, probably in 12 months' time. But of course, if you're investing today off plan, you're not going to be taking delivery for another year or so anyway in some of the projects. So in short, the PLCs are saying the prices are holding strong. It's not a big correction, and they'll go again in the future. Okay, next one. So we're coming on to our stock now. So let's go on to the next page. This is the point that I've just made earlier. It's absolutely key that you buy somewhere where there's going to be sustainable tenant demand. So you're looking for town centres, city centres, in particular, where there's regeneration, where there's new jobs, universities, etc., etc. Sometimes, for example, people will say, oh, it's in Birmingham. And it is in Birmingham, but it's in a suburb of Birmingham where there's no demand, just the local social housing type things, because it's cheap. They've managed to get the development cheap because it's in a cheap area with no demand. And of course, in the future, the type of tenant that's going to rent there is not what we're looking for. What we're looking for is young professionals in particular. That's the big market. Generation rent for the UK is these young people who, when we were young, our parents said never rent because it's dead money, you must buy. Well, now that's generation rent. The kids can't afford to buy these days, where you need a £50,000 deposit, etc. So they've been forced into generation rent, and actually they're fine with it now. There's been culture change in the UK, and from 21 to 35 or 36, for these 15 years, we've got the young professionals in the towns and the cities. They then get married and they want a garden for the kids, etc. But all of this data is well versed and well known in the UK, and this is what us developers thrive on. This is government data and data from the PLCs. So we're looking for those young professionals, many of them single. They've got budgets, they've got good jobs, and they pay their rent, they're happy. As long as there are amenities in these developments. It's changing. Before you could just give them an apartment. Now you've got to give them a gym and a spa and a residence lounge and stuff like that. And all of the developments that were involved with have been designed for this. They've been designed to attract tenants for the next 25 years. Okay, let's have a look. So the two on the left are off plan, and the two on the right are completed, depending on what your appetite is. Let's have a look at the next stage. I'll move quickly through these because I'm conscious of your time. Right, so this is in Slough. Why did we go to Slough? Well, exactly that. It's a regeneration area. It's something like 15 minutes to Paddington, but a fraction of the price. If you bought a 2-bed in Paddington, you're talking about 800 to 1.5 million. And here you can see they're 370 to 430. This will be ready, interestingly, by March next year, which is when that stamp duty saving finishes. So this is a cross-rail development. Slough in itself has got huge job, over 500,000 jobs in Slough, the biggest business park in Europe with 500,000 jobs. And of course, we're now tapping into that London market. With it just being 15, 20 minutes from Paddington, you can work in London, but live in Slough. And this particular development is right next to Crossrail. When I say right next, 50 metres away, so it's in pole position. Give you another tip about this particular development. We've actually got about 25% of it left now to sell. I think we've got something like 30 apartments here. But what are they called? Berkeley Homes have bought a site that's 1 kilometre away. It's the old Hovis factory. We looked at it ourselves, but we thought it was too expensive. They're selling that site for £600 a square foot when it comes out in January, and we're selling this for £475 a square foot. So there's real bargains here. We're right next to the train station. Our apartments are nicer when you compare. And I don't know what saving that is, £125, but it's something like a 20% saving compared to that, the Barclays scheme. So I can recommend this. One last thing about Metalworks, it's got a state-of-the-art, which I'm very proud of, state-of-the-art underground parking facility. What's a state-of-the-art underground park? But it is amazing to look at. I love going down there and seeing it. There's a chronic parking problem in Slough. There's so many apartments in the middle. There's such demand there for the commute to London and the local jobs that so they've got big issues with the car parking. And this Metalworks is the only one. We would only do this development if we could have the underground parking. So for the future, it's going to be ideal for all the tenants, and it's going to be the reason why people choose the Metalworks compared to the others. Okay, next one. The Grand Exchange. So this one's 2 years away. So this is where hopefully we're going to catch that rise in 2022 going forward. Now, so far in the SevenCapital portfolio, I would say this is our jewel in the crown. This is our flagship. The amenities here, you can see some pictures there. The amenities here are outstanding. Because Bracknell, you may be thinking, where's Bracknell? Well, it's in the tech sector. It's next to Reading. It's less than an hour to London on the train and something like 40 minutes in the car. But Reading became the tech centre in the UK kind of 10, 15 years ago. But the prices have gone through the roof. And so there's overspill. And the next big town was Bracknell. Well, if you go to Bracknell like we do regularly, you speak to the locals, the difference of what it was an ugly duckling, and it's been transformed into a swan. And that's because of the regeneration programme there. We're just a very small part of that, but they built a whole new shopping centre, a new Waitrose, and there's lots of new stuff going on. The whole of the town centre is being regenerated. And so it's a great opportunity. The tech sector, you know, we're talking, there are companies there like Microsoft and GE Capital, etc. There's literally hundreds of thousands of jobs there. And this is right in the middle of it's next to the train station, right in the town centre, next to the new shopping centre, etc. So we know that this is going to be of big demand in the future. Those amenities are things like residence lounge. There's a 5-star hotel reception. There's 24-hour security. The working space, you know, when we say, oh, we'll work from home. Well, in these apartment blocks now, the better ones, they don't mean in their apartment. They can go downstairs and there's actually a proper workspace there. And there's a workspace here for something like 100 people. It's a huge facility. And for those people, the local young professionals in the tech sector, it's going to be absolutely perfect for them. There's fine dining, there's a boardroom, there's lots going on. Have a look at this development. It's really special. It's the best one we've done so far. Okay, let's have a look at the physical stock. So the first one's in Birmingham itself. Again, we're coming to the end of Broad Street. We've got something like 30 apartments left in this one. It's in a great position. It's actually at the end of Broad Street on Five Ways Island. So it's a 5-10 minute walk to places like Brindley Place, where there's 10,000 banking jobs, and HSBC and PwC, etc. It's opposite our hotel, the Park Regis, which is probably the best hotel in Birmingham right now. And it's got a gym, it's got all the facilities, very popular. The whole place is let. There's 214 apartments here. And the outstanding feature of this development is the price. We've only got 2 beds left here, but you can see they're £250,000 upwards. Anything that we're launching in Birmingham going forward will start with a 3. The 2 beds will start with a 3. So there's no risk with this. It's ready, it's fully tenanted, and you can get it at the right price. And with all those other things that we talked about, why now, i.e. stamp duty saving and interest rate, etc., I think this is a great investment for people who want to get into Birmingham. All right, next one. I think this is the last slide for me. So number 1, Thames Valley. This is a brand new development that's just completed. We're literally handing over now this week. The tenants moving. There's 130 apartments here, and we've got something like almost 70 apartments pre-let. It's a huge demand to live here. And this is down the road from the Grand Exchange, the one we just talked about with those amazing amenities. This is a beautiful building with 2 huge reception areas. As you walk into the place, you get a feeling that you're in somewhere special. It's physical now, so if you bought one of these, you would be looking to get, if you wanted a mortgage, you'd be looking to get your mortgage in place and exchange and complete at the same time. But by the time you did that, we'd have found a tenant for you. As Johnny said, we offer the whole turnkey solution here. So if you were buying this, a traditional buy-to-let property, we would organise the furniture, the tenant, the whole thing, so it was seamless. When you completed, it would be immediately rented out, and we've got a panel of letting agents and estate agents, if you're looking to sell on in the future, to help you all along the way. In our game, as it were, our sector, the selling and the marketing is the easy bit. The difficult bit is the customer service in the back end. And so many people fail in this area, and this is where we want to excel. If you receive an email from any of our staff, at the bottom, it'll talk to you about our Trustpilot. We've got 5 stars in our Google reviews, and it'll talk to you about the awards we've won. We only want to win awards on customer service, because my final gambit before I move on to Hiten is the reason why we set this business up was because of something that happened to me in 1998, 22 years ago. I bought a property in Spain, still got it today. It's been a lovely holiday home for us. But when I bought it, it was a disaster. The service I got was a disaster. And I won't go into it now, but it gave me the idea that I love owning this property, and it went up in value and etc. It's been a great investment. However, buying it was so stressful. And once I got the delivery of it, it was a year before I could rent it out, because who do I give the keys to, and how do I furnish it, and who's going to maintain it, etc., etc. And I was just left on my own. And that's what happens in our sector today. We ensure that all of those things are taken care of. And we've got 60 people in our customer service who are just dedicated to helping the clients achieve everything that they want to once they've taken delivery. So let's have a look at the next slide. Is that me finished? Yes. So Hiten Ganatra, like Frank Sinatra, he's the owner of Visionary Finance. Let me just give him a quick intro. We found Visionary Finance about 4 years ago. They are key to our clients' success in getting mortgages. They only deal with people like Barclays and Galliards and ourselves. They're a fabulous operation, and they will help you get the best mortgage if you're looking to mortgage. So over to you, Hiten.
That's great. Thank you, Andy, for the introduction. Hello, everyone, wherever you are located in the world. Lovely to be speaking here. And thanks also, Mark, for the invitation to join the webinar today. So I'm going to give a brief summary of the current UK mortgage market. I think Andy's touched on it briefly in his presentation, and also speak about the importance of leveraging, so how you can use other people's money to help grow your wealth. So can we please move on to the next slide? So firstly, start off with who we are. Well, we're independent mortgage advisors who are regulated by the UK's Financial Conduct Authority. We've been working with SevenCapital on completed stock since July 2018, but of course, as Andy mentioned, we've obviously had our sort of interactions going back 4 years now, and we've assisted over 400 buyers based locally and worldwide with their financing requirements. We've got extensive knowledge of the UK new build market, buy-to-let mortgage market, and we've facilitated over £162 million worth of mortgages in 2019, so that's last year. We offer bespoke advice tailored to each of our clients' requirements. In terms of access to the international and the expat market, we've got access to over 20 different lenders who specialise in real estate lending to foreign buyers and UK expats. And much like SevenCapital, we're a firm that is customer service and customer relationship driven. Move on, next slide, please. What do we do? So we deliver a flexible end-to-end service from initial appraisal through to mortgage offer, which provides the least inconvenience to you. So what does that actually mean? Well, we prioritize understanding your personal circumstances and financial objectives to begin with. Then moving on to the next stage, once we've understood your circumstances, we'll provide you with transparent, quality and honest advice on the most cost-effective mortgage solution for you. We manage the entire mortgage process for you. So that means that from the initial conversation right through to mortgage application and until your mortgage offer is issued, we'll manage that whole process end to end for you. And you are allocated a dedicated case progressor that will keep you updated on the progress of your mortgage application at every step of the way. As I said, customer service is a priority, so that's what we effectively focus on. How do we assist you? So lending is available to a variety of backgrounds. I mean, there's been this misconception that, you know, if I'm based internationally, I need to be able to have the cash available for me to acquire property in the UK. We've helped facilitate a number of different scenarios. So, you know, for example, if you're a first-time buyer with no UK profile, there are lenders out there that we have access to that can help you get mortgage lending. We can assist international buyers based in non-sanctioned countries. So a lot of our clients are based in the Middle East as well as the Far East. So in essence, as long as you're not based in a non-sanctioned country, we can certainly look to get mortgage lending options available for you. Buyers who are looking to expand their UK portfolio, you might be an expat living in, for example, Dubai, and you've got a couple of other buy-to-lets here in the UK, and you want to just grow that portfolio because, as the previous presentation mentioned, that the currency gain that you can make off the back of the pound being weak against other currencies, we can look to help expand that portfolio. We can help both employed and self-employed clients as well. So it doesn't mean that you have to necessarily be employed by a multinational organization. Even if you're self-employed, we can look to help get you mortgage lending. We can also help asset-rich clients with limited evidence of income. Just to give you an example, we helped a Pakistani national living in Malawi. She had 3 buy-to-let properties here in the UK, and we helped manage to get her lending on a SevenCapital scheme that she was purchasing. So again, there are those nuances and quirks that we can help obtain mortgage lending for you on. Effectively, our job is to find you the lender that is most suitable to your circumstances. And of course, our objective is to find you the best mortgage solution that's available with the lowest rate. Next slide, please. So what is leveraging? Leveraging is simply using the power of someone else's money to make a gain for yourself. Now, what I've done here is I've actually used 3 examples. So an example 1 is effectively no leverage. So in essence, you're using your own money that you saved up through you know, other asset investments and growth in your sort of personal wealth to purchase the property cash. And I've taken a simple example just to sort of illustrate the power of leveraging and how you can use that to your advantage and get a better return on your investment. So the first example assumes no leverage, i.e. you're making a cash purchase. We've assumed the purchase price to be £200,000 and the estimated rental value to be £800 per calendar month, which equates to £9,600 per annum. The return on investment for this particular scenario would effectively give you 4.8%. So invest the £200,000 that you've saved up into a property, giving a rental of £800 per calendar month, you'll get a return of around 4.8%. If we go on to the next slide, please. Example 2, I've assumed a 50% leverage. So you're effectively getting 50% bank funding and 50% cash investment. So in essence, you're using 50% of your own money, 50% of the bank's money to acquire a property, again, that's worth £200,000. Again, the estimated rental value on this particular property, £9,600, just to keep it consistent. But here, you've now got a mortgage cost. So you're borrowing £100,000 from a bank, and I've assumed an interest rate of 4%, just again to illustrate the impact of how leverage can benefit you. Given that you're paying 4% interest on £100,000, your monthly mortgage payment will be £333.33, which will equate annually to £4,000 per annum. The net surplus rent, so that's the rent which takes the estimated rental value and deducts the mortgage cost off that, gives you a monthly cash flow of £466.67 per month, which annually equates to £5,600. Now you realise that your return on investment now increases from 4.8% with no leverage to 5.6%. And what this also gives you the opportunity to do, and Andy touched on it on his slides, where the capital growth that you can see now is you can actually look to acquire 2 properties. So you're putting 100 grand in property A, 100 grand in property B. So you can acquire 2 investments, which then gives you the benefit of benefiting from the leverage and the capital growth over 2 properties. So if prices double, they're doubling across 2 properties rather than the 1 property. So that's the benefit effectively of splitting your money across 2 properties. Not only do you get a better return on investment, but you also get the opportunity of seeing capital growth on both properties. Next slide, please. And the third scenario is where you've kind of increased that leverage a little bit further, and 70% leverage is possible depending on your circumstances. We can look to get you up to 70% mortgage lending, which means that you'd only have to put a 30% cash investment in. Now here again, same scenario, purchase price 200 grand, estimated value £800 per calendar month. Mortgage cost now increases because you're obviously borrowing 70% of the purchase price, which is £140,000. Again, at 4%, your monthly payment increases to £466.67. So you're not making much surplus rent, but don't forget, you're only really putting only £60,000 into the deal, which means that your surplus rent effectively equates to £333 and 33 pence per month, which is £4,000 per annum. Now, again, you'll see the return on investment has gone up to 6.67%. But given that you've only invested £60,000 into the deal, £60,000 with a £200,000 pot, which you would have considered investing as cash, means that you now can possibly buy 3 properties, which again ties into the example 2, where you're now getting capital growth over 3 properties as opposed to 2 properties. And I guess the final question that I'd put to you guys is, what interest is your bank paying you on your cash deposit currently? With bank interest rate lending or interest dropping on savings significantly, you know, getting 6.67% on your effective £200,000 investment means that I would expect a far greater investment return than you would if you left that money in the bank. And I think that's the last slide for me. Yep, thank you. And I guess we're probably going to be moving on to questions now, so I'll probably hand it back over to Mark, I guess.
I think it's me, Hiten.
Okay, sorry, Andy.
It's always very informative when you go through these figures. Thank you. We've had lots of questions. Thank you everybody for sending your questions in. We've got 7 typed up, and we've just got one that's coming now from Yazza. Thank you, Yazza, and it's for you, Hiten. He's asking, or she's asking, forgive me, is it possible to get fixed rate mortgage for 10+ years?
So Short answer is no. Currently, the way that the banks are pricing mortgages currently is either on a 2-year fix and a 5-year fix. The disconnect between the actual interest rates isn't overly great because 5-year fixed rates is effectively being priced at a similar rate to the 2 years. And what the markets are anticipating is for there to be not much movement in the interest swap rates that are being offered by the sort of the capital markets. So at the moment, you're only really getting for expat clients rates of which are between 2 and 5-year fixes.
Okay, good stuff. But it's a moving market, isn't it?
It is also, but equally, I think just to add to that is that if you go for a 10-year fix, invariably you're tied into that mortgage rate for 10 years. So in the event that you did see a good capital appreciation and you wanted to realize the liquidity, if you were to sell that property and pay back the mortgage, you'd have an early repayment charge, which would be a penalty to break the mortgage contract. So therefore, to remain liquid and fluid in the investment, you want to make sure that you're not tied in for too long, which limits your ability to be liquid and remain fluid in the property market. So I think that's another consideration that you must regard to going for a 10-year fixed rate product.
Yeah, I think the reason why you've asked that, Yazza, is because it's a common belief that we're going to see interest rate rises at some point in the future. They haven't happened for the last 10 years. Since the financial crash, they went down unprecedented low levels, and we've always thought that they're coming back, but it just hasn't happened. They can only really go up, but we don't know if and we don't know when. The one thing to counteract that is we do know, because of supply and demand, that rents are due to rise, just like the property prices over the years. So if we do get increased, variable rates in the future and increase interest rates, the rentals should go in line with that and help to cover them. Right, let's go on to these 7 questions that we've got. Thank you, everybody, again. What's this? Given the rise in property prices over the last few years, are we due a correction? It's a good question. I touched on this earlier when we were talking about trying to time the market. I've been investing since I was 21 and I'm 56, so 35 years. And my early properties have doubled twice. So I bought 1 beds in Birmingham for 80,000, 2 beds, in Birmingham for 80,000 back in 2000. And they're now 330,000 pounds. And so trying to time the market, you'll lose opportunities. What you want to do, if you've got the cash and it's right, and you can see that you're with a proper developer that's got a proper 10-year bill warranty and all the things that come with the right developers, and it's in a sustainable tenant demand location, and it's got the amenities, etc. There's no wrong time to get involved. If you bought something for 250,000 and in the next 2 years the market crashed and it was worth 200,000, in 15 years' time, it's going to be worth 400, 500,000 anyway. And so I don't believe we're due a correction, and I don't think it matters to serious investors. Okay, next slide. Why is it better to purchase at off-plan or new developments rather than existing properties? Good question. Back in the day when we saw prices rising so high, the idea is off-plan, of course, it's going to go up in value. You buy something for 200,000 and by the time it's ready, it's worth 220 or 230,000. So that was the initial reason. But now the market's changed slightly, and a lot of people want to buy existing properties because they want immediate rent, or they don't want to take a risk because there's been some negative stories in our sector about people not ever getting their properties and problems with it. And I think we're going to come into a period like that over the coming 12 months where, not just to do with the pandemic, we know that there's a lot of properties out there that are being sold that they're not sustainable. The appraisals aren't sustainable. So we think there's going to be some failures during the coming year anyway. And so a lot of people will buy an existing property because they don't want to take a chance of the developer going bust and them losing their money. I guess if you get a brand new apartment, it comes with a 10-year bill warranty. There's no real, apart from your service charge, your monthly service charge, there's no real other outlay, and so that's a big help. One of the things that you have to consider again is you want a hands-off property. You want something that's done for you. You don't want any calls in the middle of the night from a tenant that's not happy, or this is broken, that's broken. And again, if you buy a brand new property, all those things are normally taken care of for the first 10 or 15 years. Okay, next one, please. I can invest now, but I'm concerned, should I wait to see what happens? It's the same as what we talked about earlier about the correction. The only time you lose money in property is if you're a forced seller in a negative market. So if you buy something and it goes down in value, it doesn't matter to you. It's just a paper value. As long as it's being rented and the money's coming in, it doesn't matter if it's worth more or less. Over the 10, 15, 20 years, when you're looking to retire and you want passive income, of course, we're expecting it to double in that time. But if you're a forced seller, if you buy now and there is a correction, it goes down by 10 or 20%. So you buy something for 300,000 and it goes down by £30,000, and then you're forced to sell. Obviously, that's not good. You're going to lose something like a third of your deposit. And that does happen when we see the corrections. I don't think we're in that market now. The property market is buoyant now, and it's because of the supply and the demand. We still haven't got enough properties in the UK. So I think they might slow down. This is what the PLC said on that slide I showed you earlier, but I don't think there's going to be a negative drop. Okay, next one. What questions should you ask a developer to make sure you can trust them? This is a good question. Well, you can only really go on track record. So you can say, you know, tell me what you've delivered in the past and have a look at those and perhaps go and see some of those apartments and see what the quality's like. And also you can speak to letting agents and you can say ask them about a particular development and say, what is that development like for rental? Is it popular, etc., etc. You could also ask a developer what they know about the local area and about any regeneration plans or things like that. Another little tip for you, find out the proper address from a development that you're thinking about investing in. Get the postcode and look it up on Google Maps and see actually where it is. Because there's a lot of stock out there that's been sold in Birmingham, and it's called Birmingham, or it's called Liverpool, it's called Manchester, but it's not. It is technically because it's in Birmingham, but it's nowhere near the town centre, and it's in a suburban area where the tenants aren't going to be the young professionals who will pay £1,000 a month for a one bed, no problem. It's for the local social housing where they've got £450. And that's all that's ever going to get. It doesn't matter if it's gold plated, it's only ever going to get rented for that much money. And so there's a lot of that's going to come home to roost in the coming next year or two with some of the Birmingham stuff in particular that's being sold. I'm going on, apologies. Next one. I'm thinking of investing through a limited company. How easy is it to get a mortgage? Are you still there, Hiten?
I am indeed, Andy. Yes, limited company mortgages are available in the UK. It comes down to obviously your personal circumstances and to see and whether you've actually got current exposure in the UK. But they are certainly available. And I think whoever's asked this question, if you want to sort of touch base with the offline app, we can run through that and to see what options are available to you and give you an indication of rates, products, etc. So yeah, they're certainly available.
Great stuff. Thanks, Hiten. Just to add to that, back in the day, it was really hard to get a mortgage for a limited company. You could only get a commercial mortgage, which is 50% loan to value and 5, 6, 7, 8% interest rate. Really bad. But the British government want landlords to be limited companies. They want them to be responsible landlords because we're changing to rent from buy. I told you there's culture change, generation rent, because the kids can't afford the deposits. And so back in the day, if you rented in the UK, you were somebody that was on the wrong side of the street, and the landlords didn't respect the tenants. And so all the apartments were in real poor condition. That's completely different today. The tenants now hold the key. They know they've got the rent to pay and we want them. And so they're going to choose the developments in the best areas, locations with the best amenities. And the government have made it more tax efficient for, they don't want 5 million landlords with 1 property each. They want 1 million landlords with 5 property each. And they want them to be responsible landlords and to think about the tenant, et cetera, et cetera. And so that's why they're giving tax advantages to limited companies. And that's why the mortgage market knows the future is limited companies. And so they've now opened up, and you can now get normal buy-to-let mortgages for a limited company. We're in the middle of the transition period now. Okay, next one. Coming to the end. Do shareholders within the limited company need to be UK taxpayers or citizens? No. The limited company is a British entity. It's a UK entity. An entity being the body, the actual limited company itself, and the shareholders can be from anywhere around the world. Okay, next one. Do you need a minimum number of properties in your portfolio before you can have a limited company? So they're all about limited companies. Interested? No, you don't. In fact, we partner with a company called Get Ground. Get Ground are partially owned by the Land Registry, the British government, and Get Grounds, they've got 2 things that they do. They set up the limited company for you to buy the property in, and then they run it, they operate it. You've got to file a set of accounts every year. A typical price for that in the UK is about £1,000 a year, so it's all coming out of your pot. But Get Ground do it for £240 a year. And they point out the tax advantages to you by buying through a limited company. And there are 3 tax advantages: income tax as you go along, your rent, capital gains tax, which is what happens when you sell, you've taxed on the profit, and then inheritance tax, what happens when you die. If you've got a limited company and you give the kids the shares, they don't pay any inheritance tax. So the tax reasons to buy a UK property through a limited company are overwhelming. And so, and we're being advised by Get Ground to have 1 company per property rather than 1. I did it back in the day. All mine are, I've got a lot of properties, and they're all in 1 limited company because all of this tax advantage didn't come out there. If I was doing it again today, I would set up a new company for every single one, and I'd pay the £240 a year to have the accounts filed. Really simple. And the reason being is flexibility. When you come to sell, you can just sell 1 property in 1 limited company. Whereas if you've got 10 properties in a limited company, you can't sell the individual properties really because they're owned by the limited company. You have to sell the whole lot. You can sell them, but you can't get the tax advantages by selling the limited company. Because if your limited company owns a property, when you come to sell, if ever you do, the purchaser can choose to buy the limited company that owns the property or just the property and leave you with the limited company. Well, the beauty for the buyer is that he doesn't pay any stamp duty if he's buying a limited company. And so that's just one. And I won't go into it all now, but there are a lot of tax advantages and the reason why you should consider buying in a limited company, as long as Hiten can get you the mortgage. Okay, next one. That's it. All right then. Well, I don't know if you're still there, Mark, but thank you very much again for inviting us today. And I hope your clients and colleagues have found it useful. We'll be in touch with you afterwards. Over to you, Mark. Yeah, thank you.
Thank you ever so much, Andy. Thank you, Hiten, and thank you, Johnny. I'm mindful of everyone's time, so just want to say thanks again. Hope you all enjoyed it, and hopefully be touching base with anybody who's got any further questions at your convenience.